All right, good day to our viewers. Right, we are here today on Monetary Economics, ECS 3701. So we are having a discussion around the notes that were put in the group earlier. So just make sure that you have access to the notes. I think it's on chapter 1 and chapter 2, and then you go through with them with us here. All right, so let me share the notes and we begin the session. So remember that if you have any questions, you can always put up the questions in the group. You can always come to my inbox, or you can as well stop me anytime here and ask your question. All right, so the starting point of monetary economics is about the financial markets, right? It's about the financial markets. And I think the importance of financial markets, or the importance of this thing that we're doing here, is pretty obvious, especially if you are here in South Africa, and particularly in Gauteng. People in Gauteng love money a lot. So we understand the importance of money here. But why is money so important? Money is important because at the back of our minds, it's actually linked to the financial markets. Probably our understanding or misunderstanding of money leads us to make some conclusions that we are going to arrive at here when we talk about the importance of financial markets. All right. So financial markets are markets in which funds are transferred from people who have excess of available funds to people who have a shortage of funds. I think the definition that you probably come across a lot is when we talk about surplus and deficit units in the market, right? So whenever we discuss an exchange of those, it happens in the financial markets, right? An exchange of those is going to happen in the financial markets. All right. And then the examples of such exchanges, of course, would be bonds, shares, etc. And also activities in the financial markets also have an effect on the personal wealth. So that's why we take this serious, right? That's why we take these markets serious, because at the end of the day, they have a direct reflection on personal wealth as well as the wealth of a nation, right? How well we do on these markets, basically, as we're going to see later, determines how well we do as a nation. All right, and then the financial markets can obviously be split into different categories, right? They can obviously be split into different categories, which we're going to look at. I think let's look at those on, we're going to come across those on the next page here when we talk about the structure of the financial markets. But before then, a typical examination question, okay, these ones here that have got red there are the answers to the typical examination questions that you get in regards to these discussions here, right? So I think I'm going to leave that part for you to read. And then I wanted to talk about the structure of the financial markets. But before then, we can talk about the functions of the financial markets, which basically translates to the importance of these financial markets. Why are they so important to us? That they, in any case, the bulk of this module is about these financial markets. All right, number one, they perform the essential economic function that we spoke about, right? Channeling funds from one household to the governments, and the government, from one household or from households to the governments that have saved surplus funds by spending less, transferred to those that have got a shortage of funds. I think we spoke about this just now. Right. They allow funds to move from people who lack productive investment opportunities to people who have such opportunities. And then just give me a second there. All right. So when you are asked about the functions of financial markets, it's also about the importance of the financial markets there. Their function basically talks about their importance, right? They also help in the allocation of resources efficiently, especially capital, right? And capital in this regard, we are talking about money, right? We're talking about funds. We're basically talking about funds. So if you have got money and you don't know how to use that money, or let me not say you don't know how to use the money, you just don't have say an efficient business, or as it were, to make use of those funds, then you can as well put that money in the bank, and the bank can borrow that money to someone that's got big ideas about the money. So this is what we talk about, the reallocation of those resources efficiently there. All right. And therefore, they will also help efficiently to improve the economic welfare of everyone in the society in so doing, right? For example, if instead of you having your 100,000 stuck up in the bank, or stuck up under your pillow, rather, or in your mattress, whatsoever, if you put that money in the bank and someone has access to that money, they can borrow that money from the bank and use the money to invest and so create employment, right? So that's how the society ends up benefiting as a whole. So if we've got 10,000 other people doing the same, then it's an improvement in the economic welfare of quite a lot of people in the society. All right. And then, of course, it helps promote economic efficiency there again. There's a promotion of economic efficiency when there's a linking of the surplus units and the deficit units, the transferring of investment opportunities to those who need them. So that has got to do with the efficient running of the economy. Most of these, I think we are going to go through again later in this module, the issue of a financial crisis, how it originates, and you'll realize that some of these impediments that you get on the financial markets find expression in the collapse of in the collapse of economies and the financial markets, right? So when they are not running smooth, right, when they are not running efficiently, it affects the economy as a whole, right? It affects the economy as a whole. I think those that are doing developmental economics, there's a part there that talks about some of the problems that developing countries face. And some of those problems emanate from the inefficient running of these financial markets. So hence, you can't trust that the economy is doing well. You will do well. You can't really bet on that when the financial systems are not operating properly, right? You can't really put your bet on that, right? So an efficiently running financial market will therefore make things smooth, right? Contribute to the smooth running of the economy. And then obviously the financial market will also increase production, right? Through the provision of these loans, right? So this is pretty much linked to what we've been talking about before. And then the financial markets also allow funds to move from people who lack productive investment opportunities to those who have such opportunities. Again, so here we are just splitting these points to make them more, right? And then financial intermediaries are institutions. Okay, this is not supposed to be there, but financial intermediaries are institutions that borrow funds from people who have saved and in turn make loans to others, which increase the business opportunities in the economy. So financial intermediaries are part of financial markets, right? So these financial intermediaries, they're like banks, right? You could have banks, you could have maybe insurance companies, but they also do help to bridge that. So we are going to look at that again much later in detail in our classes. All right, what's the structure of financial markets? All right, the structure of financial markets. For starters, you can split them into two, right? You can split them into two. You can have your debt markets and your equity markets, right? You split them into two. So those notes, I think the next ones that I'm gonna send, I'm gonna correct the writing there. Right, the debt market and the equity market. So we start off by defining those, of course. So the debt market is a market which debt instruments such as bond on mortgage, which is a contractual agreement by the borrower to pay the holder instruments fixed amount, or the holder of the instruments fixed amounts at a regular specified date upon which a final payment is made. So that's the bond there. But there are also different kinds of bonds, of course. You have corporate bonds and the government bonds, right? But we normally refer to them under one bracket as debt securities, right? Of which you can get those under the debt market. Then other than that, there are equity markets. So equity markets, this is where funds are raised through the issuing of equities, right? I think if you scroll back on the notes that I gave, there should be a definition there of common stock, right? Of common stock, which is a prime example of equities. So what is common stock? It's a claim on the share of net income, right, and the assets of a business. So to simplify this, equity shareholders or common stockholders are in essence the owners of the company, right? So you are not exactly owed anything by the company if you are a holder of an equity instrument. You are not exactly owed anything by the company. In essence, the company rightfully belongs to you, right? So which is why they are saying you have a claim on the net income. So the net income is the profit or the income that remains after all expenses and all other payments have been made to third parties, right? So in other words, after you've paid, for example, you've paid your taxes, you've paid your interest in terms of, the interest that you are paying to debt instrument holders, after you've paid all those people and all those institutions, the funds that remain, the income that remains, you have a share in that income, right? And then other than that, you have also a claim on the net assets of the business, basically on the assets of the business. So in accounting terms, the definition of equity is therefore what remains after deducting your liabilities from your assets. What remains there is what belongs to the equity shareholders, right? So there are two of those, right? The debt market and the debt market, which is also called the bond market, right? Which is just an umbrella term there, the bond market. So when we refer to bonds, we are basically referring to debt in this instance. So we pretty much want to call it bonds. Why? Because of the definition of a bond, which we just gave there, right? In most cases, when you are entering into debt, you have a contractual agreement that you enter into, and in that contractual agreement, under most cases, you are going to be asked to be making some periodic payments. Sometimes you could be the one on the receiving side, right, receiving some periodic payments. Then at the end of it all, you then get back the amount that was the amount that you borrowed, or sorry, the amount that you lent the other party, right? You get back that amount. So if it's the amount that you borrowed, then it's the amount that you're gonna have to pay back at the end of a specified period. So most debt instruments are like that. If you look at a loan, for example, if you go to the bank, you need to be making periodic payments. Then at some point, we are hoping that you are going to pay back to pay back the capital amount that you borrowed from the bank. Though in most cases, these amounts, including the capital amounts, you normally paid back also over a period of time. So there are different types of these debt instruments, but we normally just trade them in the bond market. We just say the bond market, right? Which should be rightly called the debt market. All right, so on that bond market, it's corporate bonds again and the government bonds, right? Of which we are going to be looking at those also, I think, in our next class there. So remember, just to clarify this, when you talk of a bond, for example, when you talk of a bond, in the light of our discussion tonight, that the purpose of these financial markets is to transfer funds from people that have got surplus units to people that have got deficit units, or institutions that have got deficit units, right? So when we talk of an instrument like a bond, for example, you need to understand that if you're an organization, for example, if you're let's say you are, let me think of a company, Vodacom, right? Let's say you are Vodacom, and you want to expand, expand your market into Botswana, right? You want to expand your market into Botswana, and in so doing, you're gonna need some funds, right? You're gonna need some funds for your operations there, to kickstart your operations in Botswana. So where are you gonna get your funds? So you can either go to the bond market, right, which is the debt market, or you can go to the equity market, right? You have those two options there. And then there are various things that you look into, or various factors that come into play in your decision there as to whether you go to the equity market or the debt market, right? But when you go to the debt market, again, you have many options, right? But let's just say you decide to issue corporate bonds, right? Because you are not the government, so your type of bonds that you're going to be issuing are corporate bonds. So because you need money, when you issue those bonds to the market, the buyers of those bonds are providing you money, they are providing you capital. So in other words, they are lending you money, right? And you are borrowing money from them, right? So at the end of the day, what happens is they give you money, and ideally you give them a certificate, right? Which is an agreement between two of you that, all right, there are corporate bonds that you've sold to them. These bonds are 5-year bonds, for example. So meaning they are going to be in possession of those bonds for 5 years. So if they give you, say, 100 million, you are entitled to have that 100 million for 5 years. But within those 5 years, you need to be paying them a certain interest, say 5% per annum or 5% semi-annually, depending on the agreement that you guys have. Right. So effectively, you have raised funds in the bond market or in the debt market. You have raised funds there for your project. Right. But other than that, you could have gone against the equity market. So in the equity market, you are issuing ordinary shares there. You are issuing those shares most likely to the public, right? If you are a publicly traded company, you are issuing those ones to the public. So the same applies. They get a share certificate and you get the money, right? And then sometimes you can buy back those shares in future, but in most cases you don't buy back those shares, right? Those shares remain in possession of the public, right? So that's basically what happens there when you want to raise money as an organization, right? So what I'm describing there in the debt market and in the equity market, in terms of you as an organization raising money, or maybe you as the government. So if the government wants to raise money, they can do that by issuing bonds also, right? So those are not corporate bonds now, those are government bonds. And those are very secure, by the way, very secure. Why are they secure? I think we are actually going to have a discussion around this, but I'm going to mention it in brief because this is our first lesson. What happens is a bond, for example, if you take a bond, take a corporate bond and a government bond, and you juxtapose them, the prices of those bonds, right, in as much as they might be selling, giving you equal payments, or they are supposed to be, okay, let's just say if they have the same value, you find that those bonds are going to be different in the long run as a result of the risk that is associated with those bonds, right? If you say you want to buy, let's suppose VPS Bank, I don't know if you guys have heard of VPS Bank, which since collapsed. Let's say it hasn't collapsed and it's issuing bonds, corporate bonds, right? So these are 10-year bonds. Let's say 20-year bonds. VPS Bank is issuing 20-year bonds. In the light of what's been exposed in the media now, you are unlikely to buy those bonds because you don't think VPS Bank will be in existence in the foreseeable future, right? Let's not even talk of 20 years. In the next 5 years, it's most likely gonna be closed, right? It's gonna be liquidated. So at the end of the day, there are a lot of characteristics that we take into consideration with these bonds from the perspective of the providers of funds, the purchasers, the buyers of those bonds, right? You need to take into consideration the risk, etc. So I was saying this to talk about the government bonds, how these are almost risk-free, right? They are almost risk-free. Why is that the case? Because under normal circumstances, we put so much trust in our governments, right? Or the government is expected to be a very trustworthy institution, right? That's our expectations of the government. Because of a number of factors anyway, because the government is not just dealing with you, right? The government is dealing with many other international bodies, so they really can't afford to default on their payments. So if there is anyone that's going to default, it's unlikely that the government will be amongst the defaulters when it comes to payments. So when they've agreed that they will pay you back your money in 20 years' time, then if they don't have the money, they might even print the money, right? That's how much we can trust the government. Or else they can even tax people and pay you the money, in theory. Okay. So at the end of the day, when government or corporations are raising money, they either go to the debt market or the equity market, but where again in the primary markets, right? Another distinction there, another structure, right? Another element there of the financial market. So the primary markets refers to the financial markets in which new issues of security are sold, such as bond on a stock, and these ones are sold to the initial buyer. So the reason why you sell a bond or you sell equity to an individual or an institution who is an initial buyer is so that you can raise money, because those funds are directly coming to the organization, which is the one that is issuing those equity instruments or debt instruments. So you are doing that to raise funds. So that happens where in the primary market. So whenever you want to raise money, you go to the primary market, right? So because we are talking about the primary market, it also means there's a secondary market. So what happens then on the secondary market? The secondary market is where now those securities are exchanged between the individuals that own them. So the secondary market really has got nothing to do with the organization itself directly, right, in direct terms. So what happens is in the primary market, a bond is sold, say, to person A, right? Then this is a 20-year bond. After 3 years, person A decides that they don't want that bond. They can resell that bond in the secondary market, right? So it is called the secondary market. So it is a financial market in which securities that have been previously issued are or can be resold, right? So which is one good thing about this, or this is one good thing about certain instruments, that you can buy and resell them. You don't have to be stuck with it for 10 years, right? You can buy and resell those. But later, we are going to be looking at the importance of the primary market and the importance of the secondary markets, but much later. So if I don't get to look at that in class, then expect that in the short videos that I promised to be making. The importance of these markets, just so we have an appreciation of what happens and the importance of these markets from both perspectives, the issuer and also the buyer of those instruments there, right? But just to mention one, primary markets, we already spoke about how important that is, because it helps, channel those funds there from surplus to deficit, right? So in other words, it helps organizations and governments raise funds, the much needed funds for projects, right? Any of these projects that they want to engage in. But what about the secondary market, seeing that the initial issuer is not exactly benefiting directly from that? So the importance about the secondary market, besides the fact that it helps in the liquidity of these instruments, right? By liquidity, we mean how easy is it to buy and sell those those instruments, how easy it is to buy and sell those instruments in terms of converting those into money, right? So they are liquid if you are able to resell them quickly, right? We say those instruments are liquid. And then when you can't resell them quickly, then they are not as liquid, right? There are certain circumstances, by the way, that can result in you having an instrument that you can't easily resell. So such circumstances are, say, when the organization is not doing so well. You see, no one really wants to buy those shares. Then those shares become illiquid, right? And then sometimes maybe the way in which is hardly the case, by the way, but the way in which some of those instruments are structured can make it hard for you to resell them, right? For example, if a certificate is going to be worth $10,000, it's not going to be easy for you to get a buyer of those. But if it's been broken down to, say, $1,000, $1,000, it's easy for you to get 10 people, right, that can buy, that are willing to part with $1,000. All right. So secondary market has got to do with the liquidity of those instruments. And then, or those securities, right? I should say securities here. And then the other thing goes with pricing, right? Because when we talk of liquidity, now we are talking about the buying and selling of those. So those are not necessarily sold or bought at the price that was initially agreed upon between the issuer and the buyer. For example, if on the primary market a share is worth 1,000 rand, right, which is the initial issue of those shares. If you fast forward to the secondary market, it's not really gonna be worth 1,000 rand, right? It's gonna depend, of course, mostly on the perception of the market makers, right? Whether the company is gonna do well, or whether we expect the company to go bad. But again, most importantly, we are gonna be looking at this in terms of the interest rates, right? How the interest rates are gonna be affecting the price of these instruments, right? So at the end of the day, you find that you may have purchased it at 1,000 rand, but you might be forced to resell it, say, at 800 rand, or sell it again at 1.2, right? Depending on the interest rates and depending maybe on the remaining number of years on that bond. All right. Then I think the rest of that you can check it out there. You can check it out. Then just some few definitions there that might come in handy for us during the course of this module. Over-the-counter markets. So this, maybe if you did investment, which is INV 2601, I think you might have come across this again. But it is a market in which dealers at different locations who have inventory of securities stand ready to buy and sell securities over the counter, right? So in other words, this is where you trade securities via a broker-dealer network, right? So there's a network of these brokers, so you can trade them. So this is all happening on the secondary market, right? It's over the counter. That's where all those are happening there. So there are certain securities that have been made, right? And then these brokers now have the responsibility of either buying or selling those, right? Or buying and selling those, right? And then money markets. So when we talk of raising funds, again, you can either raise funds on the money market or on the capital market, right? On the capital market. So on the capital market, that's where now you talk about exactly what we were talking about earlier, the equity market and the bond market, right? Or the debt market. That happens on the capital market. Why the capital market? Because that's where you want to raise funds for the long term, right? Something over a year, you go to the capital market. Whereas in the money market, you're looking at something less than a year, right? Debt instruments which are traded for a period that's less than a year. So you're pretty much looking for, I think, back in the days, we used to call it a soft loan, right? Just on a short-term basis. So organizations and the government probably does need that also, right? They probably do need that time to time. So where does all that happen? It happens where? In the money markets, when you're looking at the trading of short-term, of these short-term instruments, right? So which is debt instruments in particular. All right, and then these are some of the financial market instruments that you can get. So these you can also go through on the notes there, the treasury bills, and then the negotiable bank certificates of deposit, the CDs, and then the commercial papers, the repurchase agreements. These ones are very important, right? I think we've heard over and over again over the past 2 years, repo rate, repo rate, repo rate, repo rate. So this is where it comes from the repurchase agreement. So there are short-term loans usually with a maturity of less than 2 weeks, right? But in most cases, these ones are over, right? They are short-term, yes, but in most cases, in practice, they are normally overnight, right? They are normally overnight, these ones. So I think if you remember from your ECS 2602, when they were talking about the Reserve Bank, they did mention that the Reserve Bank will actually force banks into a liquidity crisis so that they can borrow funds from the bank, which is from the Reserve Bank, right? And how do they do that? It's through these repurchase agreements. So a repurchase agreement generally is where they trade government securities, right? It's where they trade government securities. So from the seller's perspective, so remember we said the seller is the one that's in need of funds, right? The seller is the one that's in need of funds. So it could be the bank. It's the bank in most cases, the commercial banks, for example. They will be needs of funds, or they'll be in need of funds. So they enter into a repurchase agreement. So under a repurchase agreement, you take a government bond, right, which is the security, right? You take a government bond and you sell it to the Reserve Bank, right, with an agreement. So it's a repurchase agreement. So you sell it with an agreement that you're going to buy it back at a higher price, say tomorrow. So in other words, you say, I have a government bond. I'm gonna sell this government bond to you at 1,000 rands, right? With the agreement that I'm gonna buy it back from you at 1.5, right? So that's the repurchase agreement. And then from the perspective of the buyer, which is in most cases the Reserve Bank, is the reverse repurchase agreement. It's called the reverse repurchase agreement, right? So under those circumstances, in effect, the Reserve Bank has given you a loan, and the difference between that 1,000 and the 1.5, that 500 there, is called the implicit overnight interest, right? Which is the repo rate, right? Which is that repo rate. So whenever they talk about the repo rate going up, it means the difference between the selling price and the buying price of those government securities, right? Which are government bonds, right? So we'll see. So why I specifically spoke about this is because these are going to be very useful much later. But when we talk about these repurchase agreements, we are basically going to be talking about we're basically going to be talking about the repo rate, which is the interest rate. So I'm sure you'll remember how the Reserve Bank or the central bank affects every other rate in the market through this rate here, this overnight rate, this overnight implicit rate, which is the repo rate. So when that rate goes up, you can expect that tomorrow your payments, your house payments are going to be up. You can expect that if you're paying for your car, you can expect that your payments are slightly going to go up. And if you go to the bank requesting for a loan, you can also expect a higher interest on that. All right. And then if you look at financial intermediaries, right, the functions of financial intermediaries, I think that one there will be clearer on the next page there. But in the light of that, we talk about indirect financing and direct financing, right? What is indirect financing? So indirect financing is when you need to go through intermediaries, right? Is when you are going through intermediaries like financial institutions, right? You don't have direct access either to the lender or to the borrower. You don't have direct access, but you just go to the bank to borrow money. It doesn't matter where the money is coming from. You don't even know. That's indirect financing. Whereas direct financing now, you are going straight to the bond market or the debt market. Is direct financing. It's not going through any intermediaries there. All right. And then possible examination questions explain the functions performed by the intermediaries there. So these are some of the functions there. I think I just didn't arrange this correctly here, but I'm gonna rearrange it so that it makes a lot of sense to anybody that's reading. All right, but basically, if you talk of transaction costs, the role of financial intermediaries is to reduce these financial costs. So this is a very common question that you get, by the way. Right, what is the function or the role of financial intermediaries? So number one, the lowering of transaction costs. Number two, it enables risk sharing. So you can go through this here and see how financial intermediaries enable risk sharing, right? But in essence there, what we'll be talking about is you don't have to bear the risk alone, right? You don't have to bear the risk alone. For example, if you put your money in the bank, right, your money is going to be used to borrow to lend to a certain company, say company X, right? But there's a risk that company X is gonna fail, right? But they only took 10,000 from you, and then they took another 10,000 from the other person, maybe 20,000 from the institution itself. So that's risk sharing there. That's an example of risk sharing. So in any case, they create and sell assets with risk features that people are comfortable with. So we're not just looking at the banks. Maybe you're looking at stuff like Old Mutual, etc. You can buy securities there that that are very low risk, right? They would have diversified, etc. Whatever they do there to lower the risk, they know. All right. And then asset transformation there. This refers to the process of risk sharing where risky assets are turned into safer assets. So that's what financial intermediaries do there. So when we talk of assets here, we're talking about securities in particular. Diversification, and then again, the asymmetry of the information, right? So when we talk of asymmetric information, you need to be able to understand, right? I'm almost done. I'm 2 minutes into finishing. When we talk of asymmetric information, we are talking about imperfect information where the one party knows certain things that the other party doesn't know, right? We call that information asymmetry, right? It's like if you are about to get into a relationship with a certain person, there's obviously certain things that that person knows that they are not going to disclose to you, like in any contract. And there are things as well that you know, certain characteristics that you are going to hide from the other person. So that situation there is asymmetry of information. There's asymmetric information there. One party knows more about a transaction than the other party. So in this context here, if a company is going to be issuing, say, equity instruments, for example, equity instruments, they are going to decide on the price of those equity instruments. And the price is generally going to give you a hint of what kind of company that is. So if they price their equity instruments high, it gives you the idea that they believe that their stock is worth so much, right? It's worth a lot, hence they are charging you high. It's like a Microsoft share. You can't expect to buy that cheap, right? Because the company is valuable. But at the same time, what if the management does that to deceive you, to make you think that the company is worth something when it's not worth anything? So they are the ones that know the truth about the company, the future about the company. Say you want to buy a company outright, right? Which is the same as equity instruments, right? You just don't know the future of the company. You probably, all you have is a set of financial statements that are a reflection of the past, but you can't really predict the future because you are not hands-on in the company. So you can't know the future of the company, you see. So at the end of the day, you have one party having knowledge, having all the knowledge, and the other party knowing almost nothing at all about the organization. So the role, therefore, of financial intermediaries is to bridge that, right? Some of them actually have such information. You can look up that information on the net now, right? Where they rate these organizations and they tell you a lot, give you a lot of information about these organizations. So this is to fight this asymmetry of information there. So again, it can be separated into two. So you normally get examination questions on this. Yeah, what is asymmetric information? Then you refer, so you say this refers to a situation where one party does not know enough information about the other party to make an accurate decision. Then it can be separated into two, right? Where there is adverse selection, where here we are dealing with a situation before the transaction occurs, and then moral hazard is after the transaction has occurred. So adverse selection now, before the transaction occurs, you just don't know, right? But you can assume that, for example, if it's a debt market, you can assume that a person who's coming to you to borrow money is probably a reckless spender, right? Hence, they are coming to you to borrow money. I mean, what happened to the money that they had before? You see, so that's the assumption there that we can make. So the assumption is that in most cases, people who are attracted or people who are seeking those funds are normally people that you can rely on, right? So this problem is created by asymmetric information before the transaction. When, for example, potential borrowers who are most likely to produce undesirable outcomes, the ones that have got a high risk of bad debts, right, are the ones that actively seek out loans, right? It's like in a relationship again. The one person that's gonna break your heart is the one that's gonna be following after you. You see, that's adverse selection there. And then moral hazard. After you have given that person your heart, what are they doing with your heart? So it's after the transaction now. They start engaging in undesirable activities, right? Now that they have the money, they now start trading reckless. So that's moral hazard there. All right, enough for today. I don't know if we have any questions before we round this up.